Hello everyone, and welcome back to Chemical Engineering Economics and Project Management class. So here in segment 1.3 we discuss about a little bit about concepts of project financing. Now this diagram on the left hand side shows us the relationship in project financing, which involves three institutions: bank or lender, company, and the project itself. Okay. And there are typically two types of relationships interlinking between these three parties or institutions. So banks will act as investors and company act as producer with respect to the project. And then the project itself is usually, in terms of organization, it's separate from the company which owns the project. Okay. And these bank or lender or financial institutions, they can act individually or as syndicates, as financing syndicates, and that's usually the case for large projects. As an example of what a financing detail can look like, this is a financing scheme for the Donggi Senoro LNG project. Okay, and this is taken from this website here. So here you have, because this is a complex project, so you can see that there are more than one financing institution, and also some of the financing institution act as the financier itself, but some of them act as guarantor. Okay, so in that sense, as a guarantor, what they do is they guarantee this loan against against another party, which actually lends the money. Okay. Any project will require some sort of business plan. Okay, the complexity, of course, depends on the complexity of the project itself. Okay, so business plan needs to be prepared to seek funding for that project. Okay, and categories of business plan are as follows. This really depends on the terms, the length of time in which this business plan applies. So we have strategic plan, tactical plan, and capital budgeting. Okay, this is for long term. That's intermediate term, and this is for short term. So a business plan should contain at least the following information, also including the timeline, when they will be achieved. Okay, so objectives and aims of the company, market research summary, capital requirements, FCI, working capital, and so on, operating expenses, and so on. Okay, so before a project can be funded, first of all, there has to be a business plan for the project. Okay, because that will tell the lender about the risk factors involved in the project, and also the promise given by the project. Okay, if a lender decides to invest in a project, how much will they receive in terms of return of their investment, and also how much risk they have to bear with respect to this investment. Okay, so that's what a business plan is for. Now, there are two general categories for project funding resource. You can have internal funding resource and also external. Now, the term internal and external here, these are with respect to the organization that owns or that proposes the project. Okay, so for internal funding resources, there are two types of possible fundings. The first one is retained earnings. Retained earning is NIAT. NIAT is net profit after tax, laba bersih setelah pajak. Okay, and minus dividends. Okay, NIAT minus shareholders dividends, though that would be the retained earnings. So this is a portion of company profit that is not distributed to its shareholders, but retained by the company for R&D purposes or project financing or other similar purposes. The second type of internal funding is called reserves. Now, these are funds that are reserved to replace depletion, depreciation, and also obsolescence of production equipment. And more on this later when we discuss about cash flow analysis. Actually, these two internal funding resources are generally, in most cases, they are not that big. Okay, these types of internal funding resources are usually small because shareholders, they naturally expect to receive dividends. They don't want to give all their money back to the company, but they expect something in return for their investment. Okay, so usually that leaves only a relatively small amount of money, so it can probably only be invested for minor projects. And most of the major chemical engineering projects are funded by the so-called external funding resources. And this type of sources vary highly in terms of costs and associated risk. Now, pay attention to cost here. So what it means by what it's meant by cost is that when we look for funding for our project, actually we also have to expend some money. Okay, so you need money to get money. That's the bottom of it. So for example, if you go to the bank to get a bank loan, for example, then you will need some money for the administrative costs, right? So this is called capital cost. Okay, the level of risk is also varied widely in external funding schemes. So it is advisable that high-risk projects should be funded by lower-risk schemes, naturally. Okay. There are two large categories of external funding resources. The first one is debt or loan. Debt is funding provided by a lender, pemberi pinjaman, okay, under a legally binding promise that the loan shall be returned after a specific period and with an agreed upon interest. So there has to be an interest on the investment. Again, as we will look in a few minutes, debts can take the form of loans, commercial papers, and so on. Okay, and you can have short-term, intermediate, and also long-term debt. Okay. The second type of external funding is called shareholders' equity, and this type of funding is provided by selling a portion of ownership of the project to shareholders. Okay. And there are two types of shareholders' equity, which are preferred stocks and common stocks. Okay, it will be good for you if you can look up the definitions of these terms, right? All right, now just some quick examples of debts, the short-term debts. For example, a company receives an offer to buy raw materials at low price, but they don't have the sufficient ready cash. So they want to secure a debt with a payoff period of 90 to 120 days. So this would classify as short-term debts. There are several available options in the market. Okay, they can get commercial or corporate loans from banks, commercial paper issued to the money market, and also banker's acceptance or PA, which is a letter which essentially instructs a bank to pay the raw materials vendor valid for a short period of time. All right, so those are the types of several examples of short-term debts, and these are several examples of intermediate-term debts, deferred payment contract, revolving credit, and also term loan. I will not go through details of each of these types of debts. Please feel free to pause and rewind this video any way you want, and also I always encourage you to find other references as well from the internet, from reference books about these economic terms, okay, these financing terms. Long-term debts. Companies can obtain long-term loan by selling bonds, okay, surat berharga pasar uang, that's the Indonesian name for it, SBPU, okay, surat berharga pasar uang. So these are commercial papers that can be traded in money markets, pasar uang, okay, and bonds are basically statements that the issuing company owes a specified amount of money to the bearer of the bonds, and that debt will be paid at a specified period of time with a guaranteed interest. Okay, so that's what bond is. And these are several types of bonds, okay, mortgage bonds, debenture bonds, income bonds, and convertible bonds. Okay, again, you should be familiar with both the the English term for it and also the Indonesian term for it. Okay. Okay, and bonds can be purchased by the public. It can be traded by the public. It's a common form of investment, a very, very common form of investment. Now, this is a very important question. Should we use debt or equity to finance our project? Now, in reality, project funding strategy can be a very, very highly complex problem, and it's a sensitive issue for many projects, okay, especially for large-scale and or high-risk projects. So, two major aspects in determining the funding composition. Composition meaning how much debt and how much equity you want to have in your mix of project financing. Okay. So two major aspects, those are cost of capital and risk. Okay, various factors must be considered in determining the funding composition. For example, the state of national economy, the state of global economy. For now, in our world these days, even the global pandemic has to be taken into account when you want to finance a project. Okay, is the local economy or the national economy in the growing, static, or declining state, for example? the total amount of company expenditure necessary to secure funding, meaning how much cost of capital are you willing to pay, for example. Should the company increase long-term debts or issue equity or stocks? So these are corporate level questions that has to be answered before we determine the DER, the debt to equity ratio. And this parameter has a major impact on the cash flow of your project, as we will see several weeks down the road. Okay, so again, let me emphasize that DER is a very important parameter when you want to evaluate the economics of your project. Debt to equity ratio, okay, meaning the ratio between how much debt that you have and how much equity that you expand when you want to finance a project. All right, now this is for your homework. Okay, so number one, describe the definition of the following terms in project funding schemes. Okay, and also I want you guys to read the following link and in your own words describe in reasonable details. Okay, not too brief, but also certainly it doesn't have to be very hugely complex. Okay, the entities defined as the lender, the company, and the project. Now remember the scheme in slide number 2. There are 3 institutions involved in the financing of a project: the lender, the company, and the project. Okay, so in this article, which entities, which institution act as these 3 parties in this project? All right. Okay, so that concludes our segment for now, and we will see you in the next one. Thank you.